Hey everybody, how you doing? This is KIN234, and this is a quick encapsulation of the conversation we had the other day regarding being self-employed and perhaps creating one's own LLC. I will definitely offer the advice on the front end that if you have somebody who is a tax specialist or a person who does financial advising for your family or yourself, I would advise speaking with them about this because while I have done this and while I utilize this in my own business, if you will, uh, I am by no means the expert, and I would urge you to take it upon yourself to become as informed as possible regarding these topics, um, because man, they can make a big difference for you in terms of income and also estate planning going down the road. Now, let me go ahead and get in here. When you look at your typical employment, you'll probably be gainfully employed by a company, and that company will either pay you on a per session rate or perhaps maybe an hourly wage or even a salary. But in any event, in any of those, that company will normally outsource their payroll, probably like an ADP will do it. An ADP will then take care of the taxing component, they'll take care of the 401k, they'll take care of your health insurance. And those are things that are all decisions that are made on the front end. And once they're in, they're kind of set and forget. And then you just kind of roll with it. You choose whatever investment vehicle you want, you choose your insurance policy, and you're off and running. You really don't think about it twice. But when you when you do this and you start to jump from maybe doing physical therapy full time during the day, and then you go off and do some personal training at home at night, you're talking about a different type of animal in terms of you'd have to create your own LLC. And the LLC does several things for you. One of which is it provides a buffer between the person and risk, because there's a separation between the person and the entity. And even though the person might be going to the individual's house to do the personal training, they're doing so under the auspices of the entity. And you can distribute the risk, if you will, and if you do this correctly, you can lay off the risk completely to the entity, or at least close to completely. You still have some holes in there where you can have some perforations. You can do this for the distribution of risk. You can do it for relief of taxes, and you also have the opportunity when you're creating, say, like a mixed marketing campaign across different platforms. You can then begin to brand yourself across these platforms as the corporation as opposed to the individual. So on the creation side, you come up with a short list of your names. You go ahead and go to the Secretary of State that you'd like to incorporate in, and you go ahead and research those names across maybe different web marketing platforms like a GoDaddy. So if we go ahead and escape out here and we minimize this, and we look at this, you go to CyberDrive Illinois, we're in there, so CyberDrive Illinois, ilsos.gov, and you go ahead and do the corporate search. Let me back this out, 1, 2, and you go in and you do a corporate search on this. And in class we did I am swole, so we go ahead and go into search. And what you see here is we're going to do a corporate or LLC. And when we search this, we go I am SWOL, I am swole. And we see that it did not return any records, meaning nobody else in the state of Illinois has I am swole LLC or I am swole corporation. So you get your short list, you go to the Secretary of State of whatever state you're looking to go to. Then you'll have many corporations that will incorporate in Delaware because of tax benefits, and also Delaware is more private when it comes to their corporate records for companies through the Secretary of State, excuse me. Also, you might do like Nevada or Montana, just based off of if you're looking for any kind of tax benefit of being in any of one of those states. I would urge you to do the research on the front end in terms of what is your obligation to doing business in one of those states if you decide to incorporate in one of those states, because that could be a sticky little situation. Now we know we went to, and I did this already, I have I am swole and GoDaddy, so we know we can get iamswole.com, and I'm willing to bet that we could probably do the same thing with Instagram and Twitter. But I'm not going to belabor the point too much here. So you have your short list of names. You go ahead and try to source those out, and you find out which ones you can actually use, and you go from there. You create your own corporation, you create your LLC. Now, here's the thing. On the front end, there's really, and I made a point to say this in the class the other day, there's really only one time that you're going to have the individual pay the corporation or pay for anything within the corporation. That's on the very front end to incorporate. You could even go so far to do, much like I did with one of my corporations, is I actually loaned money to the LLC, and then I created a payments schedule to pay me back. So the LLC every month with the LLC checkbook wrote the person, that being me, a check to make good on the monies that were loaned to the corporation to start. It gets a little bit funky because you're the entity as well as the person, but what you're really trying to do here is not pierce the corporate veil. You want to have a very well-defined line between you and the corporation. And the entity itself must remain as its own standalone entity and not be in a situation where you commingle funds in between the two. Very easy to just like, oh, I'm at the store, I'm gonna grab my credit card and buy groceries with my business credit card, but you end up commingling the fund, and you don't want to do that. So remember, don't pierce the corporate veil. When you get into the startup side of it, you look at establishing things like your website, your landing page, your incorporation costs, Instagram, Twitter, et cetera. That's not going to cost you any money. Email will cost you some money, and also a host for the URL will cost you some money. But really what you're looking to do is make a loan from yourself, write up a one-page simple document that describes and outlines the payback schedule for that. It could be 1 year. If you're loaning, $2,400 is $200 a month, right? For 1 year payback cycle. And it's just that easy. And then each month, the corporate entity pays the person back at $200 a month on a non-interest loan. No problem. Now, when you look at this, you're trying to really reduce the risk. That's part of it. And, if you have some type of damage to personal property, you go into their home and you're training somebody under the auspices of the corporate entity, you're minimizing or at least reducing some of the risk because the risk is placed on the entity, not the person. And you'll usually have some type of insurance for the entity or yourself, one or the other, sometimes both, depending upon the situation. And you'll use those policies as a way to protect yourself and establish, if you will, boundaries for the entity and for yourself so they can't come after your personal assets. I made the mention of, like, God forbid I would hurt somebody and I don't have insurance, they could come after my house. They can come after my personal assets. They could take those things away if I didn't have insurance and if I didn't have that corporate entity in place. So I make it a point to have those buffers in place to protect me, the person. And when you look at it from a financial standpoint, you're also looking at how do you minimize your tax burden. And I made a point to say, many times your accountant will ask you, what are you going to be showing? What will you show the IRS this year? And they're not being funny about it. You have a top line number and a bottom line number. The gross revenue number is a top line number. The net revenue is a bottom line number. So your revenue side, you might have a Zelle and a merchant account like I had set up. And you'll have month 1, month 2, you'll have 2,000 revenue through Zelle. You have 2,800 in your merchant account. Month 2, you have 2,200 and 3,000. So month 1, your total revenue ends up being $4,800, and you got $5,160 for month 2. It comes out to $10,000 over 2 months, right? Well, you're going to have some expenses. Say you're paying rent on a studio to go work out there or train people there. That's going to be a cost you're going to incur. That's $500. If you split a personal training session with the house 50-50, whatever that amount is, that's a cost. You have to make sure you document that. And then you have maybe your auto note, or in my case, a lease, is run through the LLC. The gas that it costs to move your car from point A to point B to go train your clients. And then your phone, because you use that for business, and then of course insurance. Now with this, I use this as an example because You can prorate out the amount for the insurance across the year. I tend to just take the dollar amount in the month that it's actually paid, and I just do a one-stop payment on that for my insurance as well as membership with the NSCA. But you can see the expenses total out to 1524 and 1175, and a total over 2 months would be 2699, for example. So your net income comes out to this and this. Your net income over 2 months is 7,300 bucks, which that's your taxable amount. So you really have to look at this and go, here's my revenue, here are my expenses, and there's many, many more expenses than this. But you have expenses, and it's the total revenue minus the expenses gives you the net income. And it is that net income, and that is what you pay your taxes on. So when they ask, what are you going to show to the IRS? That's the net number. So as a business owner, you work very hard to try to find ways to reduce this bottom line number and put yourself in an advantageous situation. As I talked about in class, you might write off your health care through your LLC if you don't have insurance through the company you work for, and you'll have health savings account. That should be HSA. Hold on. There we go. Now I'm feeling a lot better. Health savings account contributions, which also can be used as an investment vehicle. You also have self-employed IRAs and other investment tools that you can use. And when you look at these, and I put these in here for your benefit, for some of them, for example, if you do a solo 401k, your contribution limit is $58,000, excuse me. And you look at that, and this is where it gets kind of funky in terms of the employee, that being you, can contribute $19,500, which could be up to 100% of your own compensation. And the employer can do 25% of revenue as a matching contribution. So dollar for dollar, you have the ability for some of these plans, like for example, a solo 401k, to be able to put $58,000 into an account and have that be an account for investments. So I put a link in here. This is part of it. This is one of the links. We'll take you right out to this. This is a great little article that hopefully helps you out. It's from NerdWallet. It's a good one. And then also I put in instructions. If you remember in class, we talked about healthcare and also HSAs. He had form number 8889. Let me get back over to here. So, I hope you'll look at this and be able to kind of process it and take it in. It's going to be a wall of information coming at you, but I would urge you on the front end, much like I said, I wish I had somebody like me standing in front of me when I was your age, and take the time to look into stuff like this at NerdWallet. What's the difference with a solo 401k or a SEP IRA? What are different ways that you're able to actually go ahead and use the solo 401k and the SEP IRA to be able to bring down your expenses? Remember, if as a company you're contributing money to your own solo 401k or any kind of investment vehicle, that's going to bring down the expense side, or it's going to increase the expense side of the equation and bring down the net income to the company, meaning you'll pay less taxes and you'll have monies that are going into an investment vehicle. So take the time to research this and seek this out, because it is to your benefit and it's something you can do to help bring down your adjusted gross income and also put yourself in the most advantageous position to retire at 50 if you want to, which I'm a big fan of that. So with that, guys, I wanted to go ahead and go over some of the information that was presented in class and give you a couple of resources that you can work from. I hope your own intellectual curiosity takes over and you kind of run with it. And I also hope you take the time to go ahead and reach out to somebody who's a tax professional who can best set you up at this point in your life to be able to really put you in a position that's really an advantageous position later in life. So with that, guys, I'm going to sign off. Have a good one, and thanks.